Good afternoon, good morning. My name is Henrik Jeppesen, and I'm the head of Invest Outreach North America for the Carbon Tracker Initiative, and I'll be the moderator for today's discussion. And today I'm very happy to have a discussion about Carbon Tracker's latest report and our report launch webinar about the report called Absolute Impact 2022, Why Oil and Gas Companies Need Credible Plans to Meet Climate Targets. The report is available on our website, carbontracker.org. Please download it if you haven't already done so. And the slides for this presentation will be made available after the webinar. This is the third annual installment of our Absolute Impact series, which is focusing on the credibility of oil and gas companies' climate targets. And we have made some updates to our Hallmarks of Paris Compliance, which are minimum requirements for announced climate targets, which we believe should be in place in order to meet the requirements of the Paris Climate Agreement. We are pleased to welcome our speakers today. From Carbon Tracker, we have Maeve O'Connor, who is an associate analyst for the oil, gas and mining team for Carbon Tracker and also lead author of the report, together with Mike Coffin, who is head of oil, gas and mining research at Carbon Tracker. And we have two external speakers. We have Andrea McHunty, Global Head of Long-Term Strategy at ENI. And we have Asim Pawan, who is Head of Sustainable Investing for Triton Partners. So with this very strong panel of speakers, we hope that we can really get around the questions about climate targets for companies. First, we will hear about a 15-minute presentation with the key conclusions from our Absolute Report 2022 report from Maeve and Mike. And this will be followed by an approximately 40-minute moderated discussion where we will bring in the investor, the company, and also Carbon Tracker's perspective, and really about how we can work and use climate targets as a yardstick and a strategic outpost and strategic outlook for companies. A few housekeeping items. This webinar is recorded. It's also shown live on LinkedIn. Slides, as mentioned, will be provided afterwards. And if you have any questions, then please use the Q&A function at the bottom of your screen, and we will try and incorporate it later in the discussion. And also towards the end, there will be a Q&A session. So to set the stage before we dive in, climate change and energy transition towards the low carbon economy continue to rank among the most important long-term strategic issues and challenges for many companies, industries, especially the oil and gas sector, but also for shareholders and investors. Shareholders have been asking oil and gas companies to set targets for how companies will navigate and handle the energy transition, given their exposure to the upstream and extractive part of the current energy system. And in the last couple of years, net zero, the concept of net zero has emerged as one of the key targets demanded by investors and announced by companies. The concept of net zero has come a long way in a very short time. It's gone from science to policy to now mainstream in less than a decade. But it's the next 3 decades, and especially the next decade, the 2020s, that really will determine whether net zero can and will deliver the required change. Propelled by the IPCC special report in October 2018 that concluded, and I quote, limited temperature rise to 1.5 Celsius and preventing the worst outcome of climate change implies reaching net zero emission of CO2 by mid-century. And this has taken everyone to focus on net zero as the unifying yardstick, if you will, and there's now a net zero commitment more or less everywhere. 90% of global GDP has made some kind of pledge or commitment or even put it into law that their economies will achieve net zero. 2 out of 3 governments or countries have made these type of announcements. 1 out of 3 of the largest listed companies representing more than $25 trillion in annual revenues. And all segments of the financial services value chain have created their own net zero alliance or initiative. We have one for asset owners, asset managers, banks, insurance, investment consultants, and my personal favorite, the Canadian oil sands producers. But a commitment is not a plan, and a target is not a strategy. We want to be number one selling widgets in Europe. It's not a plan. It's not a plan, but it's a target. A strategic plan or target requires many choices and decisions by the company, by management of the different companies, and that can be difficult, especially if this net zero has to be target to be achieved and met in more than 20-25 years out in the future, where there will be at least 2 or 3 interim CEOs in between. Equally, it can be difficult for investors to assess these targets announced by companies. What are real intentions, initiatives, and what is greenwashing? As an illustration of some of these issues is the latest net zero benchmark announced by the Climate Action 100 a little more than a month ago, where the initiative has targeted 166 companies. 69% of these companies have announced a net zero by 2050 target. That's up from 52% in the year before benchmark. 73% have set a long-term target. That means basically towards the 2050s. 77% of companies have set a medium-term target, but only 49% have set a short-term target to be reached by 25. So it seems to be easier to set long-term targets than shorter-term targets. But the key issue for investors is that only 17% have produced a quantified decarbonization strategy. So there's a lot of talk about doing it, but it's not really been put in numbers. Only 17% have set midterm targets that is aligned with a 1.5 degrees global warming. And only 5% of companies have explicitly committed to align their CapEx plans with the long-term greenhouse gas emission reduction targets, and or to phase out planned expenditures or CapEx into unabated carbon-intensive assets and products. So there's a lot of targets. There's very little meat on the bone, so to speak. So a carbon tracker, we believe climate targets are strategic targets, and those should reflect what the companies are planning to do. It's very important to analyze and understand the components of these announced targets, and that is what we are focused on here today. So today's event is about helping investors better analyze and understand these constraints that targets and limitations are putting on the company's choices and their decisions, in order to help investors answer what should be included into a credible climate targets and what constraints on the future business model for the companies will all of this imply. So with that background, I will now hand over to Mike and to Maeve to go through the presentation. Yes.
Great. So thanks for that introduction. So welcome everybody. And what we'd like to do today is to give a summary of the report we published last week, Absolute Impact 2022. So this is the third report that we've published looking at climate emissions targets from oil and gas companies. And this year in particular, we are focusing on the credibility of those targets. So the title of our presentation is Why Oil and Gas Companies Need Credible Plans to Meet Climate Targets. So I'll give an introduction to our approach to the problem, and then I'll pass to my colleague Maeve, one of the co-authors of together we wrote this report, and Maeve will give a summary of the rankings of the relative rankings of the different companies, and also explore that credibility side of things. But if we were to leave you with just 4 points from today, it's absolutely critical you have global absolute emissions reductions from all sectors to enable us to meet the Paris goals. But it's the pathway towards net zero emissions that matters. As Henrik said, with a growing consensus around the important and significant awareness about the importance of reaching net zero, but how we get to net zero is absolutely critical. We see for company goals to link through to Paris limits and the finite planetary limits, it's important they meet 3 prerequisite hallmarks of Paris compliance, and we'll go into those in more detail. We believe that corporate goals and corporate positioning on climate and the way in which they set targets can be viewed as a proxy for company strategy. Broadly, you see some of the leading European companies are setting goals which are potentially starting to be aligned with Paris goals, in that they set absolute reductions in emissions, covering a broad spectrum of company activities, including interim targets on that pathway. In contrast, some other companies are very much setting targets without meeting any of those hallmarks, and ultimately could be viewed as laggards on climate. Now, not only is this around the environmental impact, but it's also very much about the transition risks that these companies continue to expose their investors to. So that's stranded asset risk, but in terms of financial risk, but it could also be policy risk and regulatory risk too. But it's important to set targets in an appropriate way that does link through to finite climate limits. But it's also important that those targets are achieved in a credible way. And so we'll outline some of the ways in which we see companies seeking to achieve those goals and the varying credibility of those plans. So the one thing that I'd like to leave you from today would be that it's critical for investors and members of a broad spectrum of financial institutions and other stakeholders to really scrutinize the credibility of company plans. And we provide a series of questions that to help with that engagement. So the first point there, net zero is not sufficient, and the pathway matters. So for any carbon budget, and those of you who have followed our work will fully understand the carbon budget. For any given temperature outcome in 2100, there exists a carbon budget. So for 1.5 degrees C, there can be we must limit the CO2 emitted to the atmosphere to 320 gigatons of CO2. And it's that net aggregate emissions that determines the warming outcome. If we produce more CO2 than that, then the temperature outcome on a net basis, then the temperature outcome will be higher than that. So clearly this is a slight simplification of the science, but these are the very clear fundamentals. So reaching net zero emissions is important, but how we get to and the emissions reduction pathway and the aggregate emissions released by the time we meet net zero is what is critical in determining the warming outcome. So it's the pace of emissions reductions that impacts that. But it's the pace of emissions reductions that impact the level of negative emissions technologies that will be required. So if you look at the chart on the top right, we see three conceptual pathways, all of which are 1.5 degrees C, and all of which meet net zero in 2050. So the green pathway is the faster decarbonisation pathway, which we see the carbon budget is exhausted in 2050 at the point of net zero is reached, but then no net negative emissions are needed in the latter part of the century. Conversely, the red pathway is a slow decarbonisation pathway, and we've exceeded the carbon budget prior to net zero being reached. And that necessitates net negative emissions at a global scale in the latter part of the century. So clearly the pace of decarbonisation on the way to net zero over the coming 2 or 3 decades impacts what needs to happen post 2050 in order to limit temperature rise to 1.5 degrees by 2100. But reliance on net negative emissions and through a whole range of negative emissions technologies and other technologies means is a risky strategy. We see in that middle chart that what I was just saying, that the budget in that red pathway, your budget is exceeded potentially in the next 15 years. Now, what that means is it leads to temperature overshoot. So on the bottom chart, we're looking at temperature rise over time. And in that red scenario, that slow decarbonisation scenario, you're seeing temperature rise in excess of 1.5 degrees through mid-century before potentially that temperature falling back down due to the net negative emissions through the latter part of the century. We see this, and many climate scientists will see this as a very risky strategy. Ultimately, who's going to pay for those negative emissions? But in fact, even if you manage to reduce the levels of CO2 released to the atmosphere, will temperature ever come back down? So at a climate level, this is an incredibly risky strategy to rely on net negative emissions. And thus we should, if we want to achieve 1.5 degrees and limit warming to within Paris limits, we must decarbonise rapidly over the coming decades. And ultimately, that means a reduction in the consumption of fossil fuels. And as I say, the key thing here is that net zero goals are linked to a reduction in absolute emissions in the interim on the pathway to net zero. So there are many different perspectives on emissions targets. There's an environmental risk and environmental impact perspective. There is Paris alignment, and then there's the transition risk element too. So depending on your perspective, you can use emissions targets and view emissions targets through a number of different lenses. From the Paris alignment perspective, clearly there are many net zero alliances of a number of different varieties, a number of different groups, as Henrik introduced. And what's critical here is that if a financial institution has set a 1.5 degree alignment or a Paris alignment goal, that they understand the implications of that setting and that alignment on their investee companies and their portfolios as a whole. So if you've set a 1.5 degree alignment goal as a financial institution, it's critical you're investing in portfolio companies that are themselves aligned. And again, we use climate targets. We can see alignment from companies, but we can also use them as a lens for, as a proxy for strategic alignment and the way in which companies are viewing the pace of the energy transition. Ultimately, their view on the future and how fast they see global demand for oil and gas shifting, be that driven by policy action or be driven by the rise in renewables and alternative technologies that ultimately will be substituting for existing fossil demand. So there's a number of different drivers of the transition, and there's a number of different lenses through which emissions targets can be viewed. So what do we see as some of the key shortcomings in existing targets? Well, some, and this is predominantly the case for some of the leading or the largest, North American companies, some cover just operational emissions, so scopes 1 and 2, just 15% of the full life cycle emissions. So they exclude the end use, so the combustion emissions, which are part of Scope 3, and account for around 85% of full life cycle emissions for oil and gas. Other companies use an energy intensity approach. So, for example, they look at the overall energy they produce in joules and the tons of CO2 that are produced in that energy production. So you can reduce your energy intensity by adding low carbon energy sources to your mix, even if there could be no change to the absolute level of CO2. In fact, you could even increase the CO2 that results from your company's activities by on an energy, even if your energy intensity reduces. So we see an energy intensity approach failing to link through to finite climate limits, thus failing to protect both the environment, but also failing to reduce investors' exposure to policy action on climate. And finally, some company targets only include the assets that they operate themselves and do not include investments in third-party operations, through which, of course, they derive profits and value. So it's critical that corporate climate goals are framed appropriately and use appropriate metrics. And to enable us to assess climate targets at individual company level, we define the hallmarks of Paris compliance. And we see these three preconditions. Ultimately, targets must include full life cycle emissions, including both operational and end-use emissions. Climate goals must be bound by finite limits, including interim milestones set on an absolute basis. So for this, we see 2030 as a key interim goal or timestamp, on the path to net zero in or around mid-century. And goals must also cover the emissions from companies' own production and global product sales on a full equity share basis, and including downstream product sales from third-party crude. That's something we have updated or refined, I should say, our hallmarks for this year to include that final point. I reiterate, these are prerequisite conditions for a company to potentially be viewed as Paris compliant. There are a whole host of other issues, for example, remuneration policy or accounting disclosure, audit, classification of reserves, long-term price forecasts. Are those consistent with a low carbon outcome? So these are very much prerequisites. So having now reviewed our approach to assessing company targets, I'd now like to pass over to my colleague Maeve, who will be looking at applying these hallmarks to individual companies and producing a relative ranking, and then we'll also explore some of the credibility aspects we considered. So Maeve, over to you.
Thanks, Mike. So I'll have a look through our ranking table here of company emissions targets, and I'll begin by saying that here we rank just one of each company's emissions targets. Some companies have several, in which case we select that target which most fulfills our hallmarks that Mike just outlined, and provided that it covers a substantial portion of company activities, we then use that target in our ranking. So to determine what tier the company falls in, you can see there the blue tier and the yellow tier. We first look at the characteristics of the target, which are, does it include end use or Scope 3 emissions? And does it have a 2030 goal on an absolute basis, or is it an intensity basis? So in the first tier, we have companies that include both end-use emissions and that have a 2030 goal on an absolute basis. Eni retains its top spot, as it has done for the last 2 reports, thanks to its early adoption of an absolute target. As far as movers go, we have Repsol in at number 2 this year. It has moved up quite a few spaces. It was at number 6 last year. And that is thanks to its announcement of an absolute reduction goal of 30% by 2030. We then see Total Energies and BP also in the top tier, both of whom fall down on the coverage aspect of their targets. So Total's only covers energy products sold in Europe, and BP's excludes its Rosneft assets. We know that BP has announced its intention to exit its Rosneft shareholding in light of the Russian actions in Ukraine, but as at the time of publication of this report, that sale has yet been formally executed, and so the caveat remains in the ranking this year. In the second tier then, we have the companies that include end-use emissions but have interim targets on intensity-only basis. So you've got Shell and Equinor, which haven't updated much from last year. Then we have Occidental, the first North American company we see on the ranking table, who fall down due to the fact that their coverage only, or their target only covers emissions from operated assets and not those in which it has an equity stake. Then we see Chevron, who have also moved in their ranked place this year. Chevron announced what they call a portfolio carbon intensity target, which now includes Scope 3 emissions, where they did not include that last year. However, we note that this target does not extend to a net zero in 2030 aim, and it also has interim targets that are distinctly kind of unambitious. So Chevron are targeting just about a 5% reduction in carbon intensity by 2028. And if we go on to the next slide, we can see the last tier. So these again are companies which do not include end-use emissions and which have interim goals on an intensity-only basis, so no absolute targets. And here we can really see the Atlantic divide. So these are all North American companies. ConocoPhillips tops the tier as it includes production on an equity share basis. We then have our new additions to the report this year. We expanded the analysis from 10 to 15 companies. So we added in EQT, EOG Resources, Devon, Pioneer, and Suncor, all of whom vary really only in terms of their net zero ambitions. And then at the bottom of the table, we have ExxonMobil. And Exxon is sitting at the bottom of the table largely due to the fact that it has no 2030 interim goals, either on an intensity nor an absolute basis. And so it sits bottom of the table. And so that is our ranking for this year. And again, we would stress that these reflect kind of a wider risk perspective. So how are companies intending to combat transition risks? We see targets as a proxy for company strategy in the face of the energy transition and how they're intending to adapt to a low carbon world. But if we go on to the next slide then, in some respects, we see targets as only telling half the story. So the other half really is how companies are intending to get there. And how are they choosing to approach their reductions in emissions. So we see that companies have a choice. They could wind down their existing assets and not sanction any new fossil assets, essentially ceasing to produce hydrocarbons in the long term. This, of course, would result in reduction in emissions on an absolute basis, as they would cease to produce oil and gas. It would also curb transition risk for investors and companies, as they would not have any residual assets that are facing stranded asset risk in the medium term. And ultimately, it would be in line with the IEA's new projects for 1.5 degrees scenario. On the other hand, if companies are intending to continue to sanction new assets, they need to make what we're calling emission space for those new assets. And they can achieve that in various ways. So firstly, they can pursue divestments, so to sell off old fossil assets, largely those in kind of non-core regions where we'd expect to see more carbon intensive or less profitable assets being sold, and then reinvestment going back into the production of new oil and gas assets. This, of course, would allow companies to meet their targets on a company level, but from the perspective of global emissions, would likely not have an impact on the level of CO2 in the atmosphere. From a transition risk perspective, as all of these making space approaches do, still exposes investors to transition risk as fossil assets remain on the balance sheet. Aside from divestments, companies can purchase third-party offsets to offset their own emissions. This practice has faced significant kind of challenges and has been the subject of several controversies in recent years. The carbon market the market for carbon credit has historically operated under quite lax industry standards. So we've seen a lot of meaningless credits floating around, and ultimately pursuing this kind of strategy is risky as companies face reputational damage or indeed could face fines should they be found to be purchasing fraudulent credits or offsets and failing to meet their emission reductions targets therefore. Lastly, they can invest in emissions mitigation technologies. And if we go on to the next slide, we can have a look at those. So we use the term emissions mitigations technologies as an umbrella term to cover a spectrum of technologies. So they can be CCUS, carbon capture, utilization and storage, which involve capturing carbon at source and preventing it from being released into the atmosphere in the first place. Or there are also so-called negative emissions technologies, which involve extracting and removing carbon molecules from the atmosphere. So EMTs is kind of our umbrella term for all of these technologies. And we should mention as well that we recognize that there certainly is a role for EMTs to play in combating climate change. The IEA has factored in the need for some EMT capacity in their warming scenarios. But what we would say is that oil and gas companies should not use what will be very limited EMT capacity in order to justify expansion in oil and gas. And instead, we would think that what EMT capacity that will be developed should be reserved for those sectors of the economy that are hardest to decarbonize. So for example, the manufacture of cement or other heavy industries like that. And if we go to the next slide, we can see that there are several issues with EMTs at large. Generally speaking, these technologies are still at a very nascent stage and they've yet to be demonstrated at any great scale. If we take direct air capture and storage, for example, the extraction of carbon from the atmosphere, Occidental are the largest proponent of DACs that are in the companies that we have studied. And it intends to bring on the world's largest DAX plant in the next 2 to 3 years. And that plant cost a total of $1 billion and is planned to capture 1 megaton of carbon per year. But in terms of making a dent in Occidental's emissions, that amounts to just 4% of Occidental's 2021 annual emissions. So again, as far as scale goes, the technologies simply aren't there. Secondly, then there is a risk that EMTs will not actually reduce emissions for the company themselves. So here, we're kind of referring to CCS projects. So Eni, for example, has 2 CCS projects planned in Italy and the UK. And what they are doing is decarbonizing industrial sites. And certainly, oil and gas companies should put their expertise to use in helping to build carbon capture plants that will decarbonize industry. But where the issue arises is that these emissions captures won't count towards Eni or indeed any other company's own emissions reductions targets. And then lastly, we've got nature-based solutions, which have huge land-based implications. So for example, to meet Eni and Shell's 2050 nature-based solutions targets, an area the size of Spain would be required. So with all this in mind, we have put together a set of credibility criteria for investors to meet corporate climate goals. So we insist that for approaches to reduce emissions to be credible, then goals should not be achieved through asset divestments, which are to make space for continued investment in oil and gas. They shouldn't rely unduly on emissions mitigations technologies, nor should they be reliant on the purchase of third-party offsets. And we've also suggested a suite of questions for investors to ask companies when insisting or when they suggest pursuing any of these approaches, which would help investors to ascertain the extent to which these plans might be feasible. And with that, I think I'll hand back to Mike to summarize.
Brilliant. Thanks very much, May, for going through that. So I will just leave those questions up on the screen whilst I just really summarize what we've seen there. We think it's really important that investors can scrutinize company plans and ask these questions of, so for investors or broader range of financial institutions to, when engaging with companies, oil and gas companies, to ask these questions. We think these are absolutely critical. So to sum up, we've defined our hallmarks of Paris compliance, which we've refined slightly for this year, and we see those as prerequisites for companies to be considered Paris compliant or aligned with Paris. And we've used that framework in order to assess companies and produce a relative ranking of company performance, and we see who are the most progressive companies and who are the least progressive companies when it comes to climate targets. But the key focus then is also, even for those in that top band, that blue band of our table, what's critical is they have a credible approach to reducing, to achieving those targets and reducing emissions, not by divesting assets for somebody else, which will have ultimately minimal impact on the climate, in order to create space for new investment, but ultimately that ultimately they have a credible approach and they're not overly reliant on either third-party offsets or CCUS and nature-based solutions. And the final piece is, again, just to reiterate that we do see an alignment or a correlation really between those companies that have set themselves the relatively more ambitious climate targets and those companies who have strategy and recognizes the finite climate limits that the carbon budget imposes, and are accelerating their company's transition relative to their peers, and supporting reducing impact on the environment, but also reducing over time their investors' exposure to transition risk. Of course, there's a long way to go for all of these companies to transition away from oil and gas to a business model that is sustainable in the long term in a low carbon world. So I will leave it at that. Henrik, back over to you.
Fantastic, Mike and Maeve, for this run through. And as can be seen, it quickly becomes more detailed and more complex as we start to dig into what a target actually means. So with that starting point, I also think it could be great to actually hear from one of the companies, and we have E&I, representative from E&I, Andrea Mercante, who is Global Head of Long-Term Strategy, with us today. And I think this is an excellent opportunity to hear his perspective and their perspective on this process around setting targets. What is the drivers behind this? So Andrea, maybe you can do a quick little introduction of your responsibility, what your responsibilities as Head of Long-Term Strategy covers for E&I, and maybe also you can describe and explain a bit about the internal process that went ahead of E&I's announced net zero target and climate targets. Were they driven top down from the board of directors, CEO? Do they come internally from or bottom up from strategy, business development, such as yourself, or do they come from external shareholder or stakeholder pressure from initiatives like Climate Action 100 and etc.?
Okay. Hello, everybody, and thanks, Henrik, for inviting me to this event. So for the first question, what's my responsibility? I'm actually responsible for Eni's long-term plan, which is basically the decarbonization plan till 2050. I also oversee the competitors' activity and results, and I support the portfolio management, meaning identifying opportunities for asset divestment and acquisition in compliance with our long-term goals. So as for how we proceed with our long-term targets, it's definitely a top-down activity. Okay, so everything basically started from the UN Agenda 2030. After that, the mission was rewritten, and in our new mission, we highlighted the importance of the decarbonization, the preservation of the planet as a first sentence. So this is actually a very important milestone for us, because after that, the whole company started focusing on this objective, and of course, starting from the CEO, the board of directors, and the top management, but then going down to the whole company. So basically, all the business plan and the business model is now drafted in a way that has that pillar in mind. Okay. So from 2020 we started to publish our long-term plan, so setting targets for the decarbonization, and every year we proceeded to update our strategy in order to clarify to our investor and to all of our stakeholders what was the strategy, the milestones, the intermediate targets, and in order to commit every year a bit more. Yeah, that's it.
Fantastic. And maybe you can talk a bit about what has been some of the main challenges or opportunities that has arisen, both as you see it internally, but also externally, that you have encountered when you have been doing these, laying out the groundwork, and found how have you been setting these targets, and how you set the goals, and how did you manage to overcome them? What has been the key learnings? And maybe afterwards I'll talk a bit about the scope 3 element, which it's maybe the more controversial thing, or the things that can lead to some contention. There seems to be an Atlantic divide between European companies and North American based companies about who and how can you incorporate scope 3. How can you talk also a bit about what have made you choose to incorporate scope 3, and how have you approached this process? I think that would be very interesting for the audience and investors to really get a good understanding of.
Sure. The challenges, I would say that the main challenge I encounter in this activity is the fact that the future is very uncertain. So every time you look at the scenario, IPCC and others, there are so many possible paths, and the variable that influence this path are very are wise and unpredictable. So you have technological advancement, you have political regulation, you have social dynamic evolution, and so on. So it's very difficult to understand actually how the future will shape. So drafting a plan that goes to 2050 is not definitely easy. So you have to develop a lot of sensitivity to make sure that basically what you're telling is it works in basically all the scenarios. Going on the scope 3, definitely that's also a big challenge. So as you said, there are not unanimous standards. We decided actually to be very rigorous, so to use a very rigorous methodology. So we decided to include scope 3 because we believe that any strategy in the oil gas industry should include that item, which represent the most of the emission of what we should be accountable. We decided to adopt a life cycle approach, so that means linked to the energy sold, and we also decided to include third parties purchases. So we decided not to limit the calculation just to our production, but also to third parties. And this is particularly challenging, especially because we are also a midstreamer, like for the gas. So we actually buy a lot of gas, so that increase a lot the threshold. Lastly, we include all of our business and geographies. So we haven't excluded anything. So is an overall target without exclusion. So we try to be as much as rigorous as possible, as I said, in order to be not, I mean, so it could not be attacked, and it could be credible. Okay. And then, of course, said that the Scopefree item is definitely the most contentious. We are working hard actually with OGCI to develop standardized reporting system, also with the TCFD. So because we believe it's important to have a shared standards, a common standards, in order to be able to compare all the targets together.
Fantastic, and yeah, I think standardization is definitely one of the hot topics. And talking here from the United States with the upcoming SEC new climate rules, I think there's a lot of focus on the Scope 3. That seems to be the main thing. The oil and gas sector is really focused on trying to find out how they can crack that nut. But and then maybe a last question for you before we move on over. So there's a lot of stakeholders involved in this, both internal and external, but especially shareholders and investors is the area that we are very focused on. Can you talk a little bit about how have you used and incorporated views from engagement with shareholders, and how do you use shareholder engagement as part of the process for you setting climate targets?
Well, we care a lot of our investors, and we are very active in the engagement with both investors and other stakeholders, especially on climate topics. As I said, since 2020, we started our long-term plan. Every year we update that plan, and we make sure that it's part of our strategy presentation. Every year we add some piece of information, and we make sure that we include targets on all dimensions. So the main input we receive from the investor is to have a credible plan. So we try to provide as much as information as possible in order to make it credible, as you also said in the remarks of the reports. I think we're doing well. I mean, at least looking at your report, but it's not just, of course, it's not just Carbon Tracker. We're doing well also with the transition pathway, with the Carbon Action 100+, Net Zero Benchmark. I think we're doing a very good job on giving all the information required to assess our strategy, and to make sure that everybody understands actually where we're heading to.
Fantastic, yeah, and congratulations on your top ranking here in the Carbon Tracker research. And we could, of course, also from your comments before, it seems that there's a big overlap between the components that we have outlined, third party and oil production, etc. That so maybe you have had a sneak preview or sneak view at our prior year's reports to make sure that you got involved here. So maybe move over to Asim here now, because now we've heard a lot from the companies, and it's incredibly complex to set out these targets and work with them, and there's a lot of interest at stake here. So maybe you can give a little intro of your responsibility of head of sustainable investing at Triton Partner. What is your position? How you're working with analyzing and using companies' announced climate targets, and maybe a question for you as an investor is: are these targets, are they nice to know, or are they a need to know information to really evaluate a company's climate strategy?
Okay, thank you, Henrik, and my other panelists. So I joined Triton last September. Triton is a private private equity buyout investment house, and it's actually my first time working in private markets. Most of my career in sustainable finance and ESG has been more focused on public markets. I was sell-side research analyst for about 7 years until last summer, and I've had other jobs before that, but mostly public markets. I've worked with Carbon Tracker in the past on things like energy system scenarios, and I'm aware of all the great cutting edge research they do in bringing the debate right to the forefront. So it's good to be involved once again. So your question, actually, so a bit more of an intro. What do I do then? I guess at Triton. So we've had an ESG team for about 8 or 9 years, and it's been very focused on the operational side of ESG. So for the period that we own a company for, it's been focused on the environmental, social and governance policies and practices, processes, reporting around targets. My job has really been to embed sustainability across the entire private equity process. So it's important to how we raise money increasingly. It's definitely important to how we deploy money. We want to buy companies with good sustainability tailwinds, which look future aligned. You know, we're going to own these companies for 5 or 10 years. They're liquid investments. And so we need to make sure that we're on the right side of all of these sorts of trends. And so the deployment of capital is core to my job. And then, of course, we need to make sure sustainability comes through in our exit strategy as well. So your question then around whether or not these are nice to know or need to know. Well, I mean, I think if an investor is buying shares in a listed company, then both a target and a strategy and, you know, pathway, stepping stone, so all the things which, you know, Mike and the others have been talking about already are very important, because unless you're purchasing a very, very material stake, it can be, you know, the road to achieving a radical transformation of that company can be very complex. That's why the shareholders group together a lot in ESG, because then they can be more activist and achieve greater leverage for change. It's different in private and buyout situations. You know, you own most or sometimes often all of a company. It can be easier to achieve change, and indeed, you know, increasingly, we have the support of the managing partners of the entire firm to try and achieve that. So, you know, that's exciting and rewarding. But actually, buying a company without targets or without a strategy may also be attractive, because it can be part of the turnaround story at the company. It's part of the value creation story. You know, Triton has historically marketed itself when it's raising new funds as an investor which is thematic for sure around its core sectors, but is also a fix and expand company. And so we seek to buy companies where we think the potential of that company is much greater, and we can fix them, to use that word, in many different ways. And one of them can be around sustainability. And so that's very important. I think you used the word prospects, and that's also very important. So the question then, I guess, for us is whether it's, you know, when we're considering an investment, whether it's actually possible for a company to align with Paris targets at all, given the products and services which it brings to market, either through operational improvements or indeed if it needs a structural or kind of strategic step change.
Fantastic, and maybe just building on that part. So buying companies without plans, of course, is a great opportunity to set them out there. But the companies that have worked and have laid out certain type of plans, and both from your current and also from your prior experience, what would you say have been some of the typical shortcomings or flaws when you're sitting from the outside looking into companies when they have announced climate strategies and set targets? What are some of the flaws or shortcomings that you have typically observed?
Yeah, I think to answer that, I'll probably end up reiterating, or at least, you know, resonating with a lot of what Mike and Maeve have already said, and that's probably no bad thing. I think, you know, the biggest flaw really is when you have that disconnect between target and strategy, between you know, a pledge and deliverables, to use different terminology. You know, we've seen many companies, public and private market, with a big pledge to decarbonize, then earning temporary plaudits for doing so, but then really failing to map out a realistic pathway to achieve, you know, concomitant emissions reductions. I guess given the valuation premium which the market increasingly gives to, let's just say, climate alignment or Paris alignment, then such a disconnect should be increasingly irrational over time. I think the ways in which, you know, companies can show genuine intent, and again, you know, the guys at Carbon Tracker and Andrea have already outlined these to some extent. So being quantitative is very, very important. It's about using science for the targets, and, you know, there's multiple initiatives and associations to help companies do that, so there's not really much of an excuse. And then, you know, using energy system scenarios, which I mentioned briefly already. I think the TCFD have that at the core of their kind of strategy component. You know, many people look at the IEA, the International Energy Agency, which is good. They've got lots of great people there doing great work. Carbon Track have done their own scenarios in the past to show, in particular, the role of solar in achieving Paris targets. And then, as I mentioned at HSBC in the past, or kind of alluded to, that was really a core part of how we try to differentiate our sell-side research offering from the rest of the street. And then, of course, the oil and gas companies have their own scenarios as well. So there's many different ones you can look at, and actually, comparing is probably where the magic lies, and understanding the inputs, of course. So using a quantitative approach to show the building blocks, really, which entities can take towards targets is absolutely key. And then I guess what you really want to see evidence of is how you is how you're achieving emissions reductions off the back of all of this, using a mathematical quantitative approach to show all of those stages. What's your target? How did you get to it? What's your scenario for reduction? And how are you actually doing against that? That's how you prove that what you're doing is not greenwash. I think really the key lies within there somewhere.
Fantastic, and thank you. And then Mike, just to come over to you here. So maybe you can talk a little bit about, you've been working on developing these hallmarks since actually our first report, I think, was called Balancing the Budget back from 2019. And we have done a couple of, now this is the third absolute impact report where we have mapped out, and we have actually created more like a framework around this here. Can you tell about what has been your intent of your ideas behind developing this framework, and how should investors and company use the ranking and the ranking system we provide here? And maybe the question is, should Andrea here now lean back and rest on his laurels because they rank number one in here, or will he and the rest of the sector have more to do?
Sure, thanks, Henrik. So, as you say, we have refined our hallmarks of Paris Compliance that we first introduced in 2019. At the back end of that, before starting the Absolute Impact series, and this is the third report there. So why did we set out to do it? Well, I think when we first started looking at these, I think the first thing to say, the landscape was quite different. Actually, the companies were starting to set climate targets, and ultimately companies are setting climate targets to maintain a social license to operate, not least through a pressure from a whole range of different stakeholders, be they Greenpeace and Extinction Rebellion, through to the financial institutions seeking to align with Paris goals, or internal pressure from staff, or policy action as well. So for a whole host of reasons, companies sought to set targets. But if we wind back that 2.5 years or 3 years, companies were setting targets on very, very different bases. I mean, they still are. However, I think there has been some convergence and a bit more correlation or agreement in how companies or standardization how companies are setting targets. So certainly that was one aim. One of the aims was to cut through the company's disclosures and the company targets, and actually seek to say, okay, on a relative basis, which one of these companies is relatively more progressive on climate, and which company targets actually tie through to potentially having a positive impact on the climate, or a less negative impact on climate, and which of these targets don't. And so it's creating that assessment framework to enable a whole series of external stakeholders to assess those targets. And of course, by taking that into a report, into the relative ranking, what we're doing is allowing companies, investors, to assess companies against each other as well. So how is the company doing, standalone on itself? And that's the hallmarks. How are they doing against peers? But crucially also, how could they be improving their targets? So what are the shortcomings in companies' existing targets, and what could they be doing to make them better? So, and I think we have evolved our hallmarks slightly over time, partly in response to the ways that companies have sought to set targets and updated their targets, and not to say that companies have exploited loopholes, but we have refined our targets to ensure that we are still providing that framework, and we think that framework is meaningful for a whole different range of stakeholders. And ultimately, the framework is incentivizing and encouraging companies to set targets in a way that does link through to finite climate limits, ultimately to reduce the impact on global warming, and ultimately stabilize temperatures at as low a level as we can at temperature rise. So I think that's the sort of the overflow. To a second part, should Andrea and any rest on their laurels? Well, I think, as we've seen, we see them as being relatively progressive in this space, and of course they as a company has set interim goals, sort of quite significant interim goals down through to 2030. But of course, the second part, of the presentation was around the credibility of those targets. So again, it's how much space is being created for further investment into oil and gas versus actually winding down existing assets. How many assets are being divested, sold to third parties, potentially may operate those not necessarily with worse or higher carbon intensity operational, but also things like methane, for example. So if those projects go into hands of other companies who may operate with worse standards around methane, which is actually a very potent greenhouse gas, particularly on a short-term time horizon. So I think it's increasing that credibility, reducing reliance on things like offsets, nature-based solutions, CCUS that's not yet proven. But if companies, and this is certainly not a comment just to ENI, but more broadly, if companies really do believe in the emissions mitigation technologies they've got, demonstrate to wider society at what point they're going, the level of emissions they will actually reduce, what is the timescale for deployment, where is the capital, and has the capital been identified, has the land been identified? So again, ask that series, ask investors to scrutinize company plans, but also companies should be able to scrutinize themselves against those credibility criteria and the questions we've laid out. Anyway, I'll pause there.
Fantastic, and maybe just we have a couple of questions from the audience, and I think one is very pertinent at this point here, because somebody is asking here. So if the company is seeking to use offsets as part of their targets, does Carbon Tracker have a view on like a threshold of how much offset can you buy? How much can you go out and buy and buy in the market? Have you made some thoughts about this?
Sorry, Henry, is that for me? I think.
Yes. Sorry.
So no, we haven't. We haven't defined what is an appropriate or an acceptable level of offsets. I think what is critical is that if companies are appealing to offsets, that those offsets are, as we just said, identified. If they're planting trees, okay, well, saplings don't absorb very much CO2. You need to wait till trees are 20, 30 years on from actually to reduce at meaningful levels. So it's very much about the understanding the details behind those offsets, and of course, transparency. Offsets may have been bundled up, passed, traded. Actually, if you're using an offset to offset a molecule of CO2 here, make sure that there is a molecule of CO2 being captured there that would not have been captured or taken out of the atmosphere had the offset not been bought. So protecting a forest, does that really justify you now burning a litre of petrol in your car? Or would that forest have continued to absorb CO2 anyway? So it's really about increasing the transparency of offset. So no, we don't have a specific view, but again, it's very much a company that's over-reliant on offsets, particularly offsets that will not actually result in negative emissions for some time to come, to justify continued shorter-term consumption of fossil fuels and the emission of CO2, ultimately raising atmospheric CO2 temperature. Again, I've come back to that my original slide. If we do exceed the carbon budget prior to net zero, and we do go into temperature overshoot, can that be reversed? Isn't that rather risky as a global strategy? And of course, we know that the worst of the aspects of physical climate change disproportionately impact the global south as well. So again, it's that there's a comment here on a question around social. Well, actually, we know that the global south is disproportionately impacted here. And actually, what is the implication there for a temperature overshoot and a reliance on things like offsets, longer term negative emissions to bring temperatures back? And who's going to pay for that as well? And again, I'll pause there.
Fantastic. And we are now up against the hour that we have allocated to this. Unfortunately, I think we could talk for a lot more about this, and I think it's incredibly important for investors and for companies to be in alignment about what are they looking for, how are they planning their future ahead. So we're respectful for everybody's time. I would like to thank the panelists, both to Andrea and Asim, and Maeve and Mike for your presentation here today. The slides will be made available afterwards, after the presentation here. And I hope that we can invite you back to a further discussion, maybe dig a little bit deeper into one of the small topics I had left here for the end, but we ran out of time, is can the oil and gas sector achieve their climate target without carbon capture? I think that could be a very interesting question and topic to discuss. So hopefully we can invite you back for a further discussion about this. And with that, I want to say thank you to everybody and enjoy the rest of your day.